All right, welcome back to the Road to Retirement podcast. Tony Marlette Jr. here at Brookside Tax and Financial Group with Tony Shore out in Minneapolis at Gradient. Good morning, Tony.
Well, good morning, Tony. Two can never have too many Tonys. That's the thing.
I just hope people don't get confused.
People will, I'm sure. Tony Marlette Jr., your name is in big bold letters there.
Yeah, where's yours?
You're the host of the show. I don't know where my name is at, but that's okay. I'm just here to ask you questions. And
that's all right. We'll put that up. That's more important anyway.
There you go. I like that too. That's good. So people, if they have questions about what we're talking about, or if they want to say, hey, next week, talk about this. I want to know about this. And we love to hear from our viewers and listeners out there. That's awesome, Tony. So, Tony, how have you been? Now, you have a 2-month-old, so I'm surprised that your eyes are open currently.
You know, Chris wouldn't let, I tried the, I still have a 2-month-old, almost a 3-month-old. I can't come into work excuse, and he didn't buy it for some reason. I don't know why.
Yeah. Chris is going to still make you come into work. Where is Chris out and about today?
He is, he's got a full calendar. Him and I have been trying to switch off weeks on these.
That's good.
So 2 people per, I think, you know, as long as we get you, that's the important part, right? I think that's the moral of the story.
Right. So what are we talking about today, Tony?
So you mentioned earlier about if somebody wants to hear something, and I have our contact info on the screen now. For those of you who are not viewing, it's brooksidetax.com. You can check us out on YouTube at Brookside Financial or on Facebook at Brookside Financial. Aaron, our marketing manager, does a fantastic job with keeping everything up to date. You can also call us, obviously, 440-886-3550. You like what you hear, you don't like what you hear, let us know. Our episode today is going to be based on client feedback about how to grow, protect, and preserve your savings. I mean, the real question here is, do you approve or disapprove of my use of the Oxford comma? So there's like people that are pro Oxford comma and anti. I'm obviously very pro. I like to
I'm pro.
between...
I like that. Steps to grow, protect, and preserve savings. As a radio professional over the years, if you wrote out a script or a title for me to read, that is exactly what you want to do, because otherwise it doesn't make sense when you say it out loud. So nope, the Oxford comma has to stay. Steps to grow, protect, and preserve savings.
Perfect. All right.
Yeah.
And we do talk about these things a lot on our show, but I think now it's just, it's interesting because it's hard to get. I mean, it's always hard to get all 3, but now it might even be hard to get even 2 of those 3. So,
Sure.
You know, it's going to take a combination of things and a tandem of things. Obviously, as we've mentioned before, there's no right answer for everybody. It depends, you know, what your goals are, your strategy, your time frame. We talk about all those things, all your circumstances. So, you know, that's all going to depend too. So When we talk about growing, obviously that's going to take some time. Sometimes if we're in the middle of a good year, stock market wise, may not take as much time, but you want to have time on your side to be able to grow assets and to take on risk. If you do not have the time on your side, and you know, we see this a lot with clients who got really used to the 12-year market run up, whatever we had between 2008 and 2020, the market run up where we were really spoiled, who say, you know, I want to get back to that. Well, yeah, of course. I mean, we all do. But at the same time, if you don't have the risk tolerance for it, I should say, if you don't have the time frame for it, for a potential recovery, you know, you need to start scaling back and lessening the risk that you have. So I think growth really goes along with time here.
So you're saying, you know, growth is so important with your retirement savings, your investments, your 401ks, your IRAs, your portfolios, whatever you have, you need growth on at least a good chunk of your money that you're going to use for retirement, because obviously you want to grow that so you have enough money in retirement. But it really is tied to your time frame how much growth you can afford to go after, because growth comes risk, is what you're saying.
Yeah,
So growth
absolutely.
is tied to what people call, you've said it before, you and Chris, time horizon.
Mhm.
Everybody's time horizon is different, right?
Yeah, absolutely. It depends where you are and where, when your goal is. So if you have a goal for a year from now and you want to turn, $5,000 into $50,000, I mean, all I can say is good luck. It's
Right. I wish I could do that.
Well, of course, and if we could do something like that, if there was a calculated way to do that anyway, without taking on extreme risk, obviously everybody would be doing it. At the same time, throughout the last, I'd say 5 years, I've seen a lot of younger investors worried about taking on risk, and
Mm,
part of me doesn't blame them. The other part of me says, you got to get over it and think long term here. If
sure.
inflation has been about as low as we've seen in 2 years, and it's still almost 5%, your savings at best is just keeping up with that right now. At
Right.
best, just sitting in a cash, like a money market or a CD. Again, I don't think you're keeping up with it. You're losing, and that's one of the big concepts here too that people don't quite get is it's fine to have cash. We want you to have cash, and emergency savings and access and things like that. But too much can be too much, and you have to at least keep up with inflation. And if you do that, you're just treading water. So you do have to
Yeah.
take on some risk, especially as a younger investor. Say if you're just starting off your career.
Well, yeah, especially if you're younger. So if you're younger, you can take on more risk to get that growth, is what you're saying. If you're closer to retirement, you've got to ease back on that risk.
Sure. Yeah. And I mean, that's where our protect comes in. So
Okay.
it used to be, the 60-40 portfolio, the famous 60-40, stocks, 60% for growth and risk, bonds, 40% for preservation. That kind of used to be the cookie cutter approach that a lot of people would take. I think that's been the last few years anyway, gone a little bit to the wayside. Bonds in a rising interest rate environment, and we've hammered this before, I won't go too much into it. Bonds lose value, existing bonds lose value in a rising interest rate environment. And even right now, as I talked about on our last podcast, which I did by myself, and it was a little awkward. It was weird. It was weird without you.
Yeah, it's not the same doing it by yourself, is it? Yeah,
No,
I was out of town, so
no, you're fine.
you had to
Yeah.
go it alone.
I did. It was okay. It was about 11 to 12 minutes, but it was just me. I had no feedback. I had nobody to ask questions or go back and forth with. So
Sure.
you were missed. But the protect portion here is no longer. We don't necessarily look at it as put your safe money in bonds, right? It's not. It's not bonds are bad. You can't have any. That's not it either. But for the protect portion, create what's the saying, necessity breeds creativity, right? So bonds were struggling with interest rates going up, so we moved clients into assets that have protection that still allow you to participate in the market to varying degrees. So we've been looking at doing things like that for people's part of their protection portfolio. And I think bonds, if anything, have been relegated more to like a dividend or an income play at this point. They've
Sure.
been still pretty good with that.
Sure. So, but how do we, so when bonds aren't cutting it for that protection we need, what do you do to minimize risk? There are other options out there to minimize your risk, right?
Yeah, yes, correct. So
To
we've been
protect your money.
doing, yeah, fixed index annuities are really good with just protecting the bottom. And then also, I think Chris, I'm pretty sure Chris did one last week, a review on an index annuity, an index link annuity, where maybe not necessarily 100% of your uh, bottom is protected, 15%, 20%, but you can participate in a higher amount of what the market's doing in those. So
Sure.
we can either
Yeah.
protect 100% of the principal, guarantee it, and allow you to participate in, a limited upside. And the upsides right now really aren't that bad at all.
No, and that's why a lot of people right now are, especially with the interest rates the way they are and the rates being what they are. That's what Chris said last week. That's why, to protect that principal, but yet get some halfway decent growth at this point because of interest rates. That's why fixed annuities and fixed index annuities especially are great, because the principal is protected. That's guaranteed by the claims paying ability of the issuing insurance company. So you've got that protection on your principal, which is important. And then you get to participate in certain amount of growth. Some are as high as 10%. If the market goes up 10%, you get 10%, right?
Absolutely. Yeah. And I mean, you bring up a good point about the protection there, with protection based on the issuing strength of the corporation. We only want to work really with the highest rated insurers. And these solutions are usually sold by insurance companies many have been in business for 150, 200 years right now. Can't say like, oh, they're not going anywhere like that. It's more based on the assets and the track record and the claims paying ability.
Yeah, and they actually have stricter regulations than banks as far as how much of that they have to have on hand. They have to have 110% of your money on hand to pay you back what you give them. Whereas banks do not.
No.
They can invest it. Obviously, we've seen that happen.
Yes.
And I think the insurance in most states for annuities is about the same as banks as far as dollar amount. The FDIC insures banks. The insurance companies, there's a state insurance they use that protects 250,000. But I did read that no A or B rated insurance company, the ones you use, has ever not paid out an annuity ever in the history of insurance companies. So
that's right. I was going to say
important. That's important to note, but it is different. The government has a insurance for banks, and insurance companies have their own insurance, and private insurance and state insurance. So.
Right. Yeah. Excellent point. So you kind of have that two layer of protection there between claims paying ability and then being backed up in our case by the state of Ohio. And I was going to say, I don't think any of our insurers have ever even had to use the state protection, but that's to your point about no A or B rated company.
Yeah, because people get worried about annuities. There's a lot of false information, and there are some that aren't good right for you, and you should never put all your eggs in one basket. That's what Chris said last week. So I think that's good. But protection is good. Obviously you want to take steps to protect what you have, especially, and this has to do with time horizon too, right? Growth or protection.
Absolutely. Yeah, that's a good point. So you really you shouldn't worry too much about protection the further you are away from accomplishing your goal. Generally speaking, the younger you are, the earlier you are in your stage in your working career, the less you should really be worried about protection. I always use the house example. If you buy a house and you plan on being there, it's your forever home. You're planning on being there for indefinitely. If the housing market collapses 2 years after you move in, you're not going to get out of that house, pack up your family, move and sell at a lower value because the housing market went down. No, it's a long-term vehicle. It's a little bit different than an investment. You live there, you build your family there, et cetera. But you don't just get out and sell at the first sign of trouble because it's a long-term solution. So think of your investments the same way. You get out of it when things are going rough and get into protection, and then get back into the market when things are going well. That's literally the exact opposite of what you should be doing. And we've seen some younger people do those things.
Yeah, people panic in 2022. The markets start going way down. People are pulling out. And boy, if you've got 10 years or more, that's when you should put more money in, is when the market has a horrible year. Right. That's when you want to be throwing more money into the market so you can ride the growth, because it always comes back.
That's right. You're shopping off the clearance rack at that point.
Yeah. But you don't want to do that necessarily if you're a year or less away from retirement,
No, definitely not. Definitely not. You want,
and that's why that you just illustrated the point of why you need to work with a financial professional like yourselves, financial advisors who are going to be able to look at the big picture, not just growth. Or, the problem is there's specialists who call themselves financial planners out there who are just about the growth. They're just going to invest your money in the stock market. And there's some that are just trying to sell insurance to make a commission, and they're going to sell you on maybe protection. And then there's some, the banks are just going to say, just put it in savings, right? And keep it in liquid. So you need somebody who's going to look at all the tools, because like my dad always told me, Tony, he always said, if all you have is a hammer, everything looks like a nail. And so, and I know a lot of our listeners have probably heard that expression, but you want somebody who's looking at the big picture. Not everything is a nail when it comes to your finances.
No,
right?
Absolutely. And that's good advice. I think that, sometimes, like to your point, people are looking for a transaction, and, they get their transaction, say they take your money, they may put you into something, and it may be something that's pretty good for you. But you never hear from them again. So there's no ongoing advice or anything like that. We work with our partners over at Gradient to put together an overall financial plan for you. And that's part of where our preserve comes in. We mentioned before, protecting, not necessarily the same as preserving. Protection means obviously what we just talked about, reducing your risk altogether. Preserving means locking in what you have, or at least starting to create an income stream off of what you built. And it's a lot easier to do that when we can look at different parts of a financial plan. If you have, say you're in the market and the market's up, we might say, okay, well, let's lock in some of those gains and start the income stream when the market's up. There's a whole chart. It's actually fascinating about sequence of returns, where you don't want to start taking money out of something when the market's down, because then you have more to build up on over time. It's really interesting. But when we talk about preserving, on the flip side, if the market is down, then that's when we start taking from the assets that we've reserved for a little bit more safety. And when we develop the financial plan, like I talked about, we kind of take everything, put it all together, and we can break it down. You should take it from this account based on what we know now. Obviously, things change, and financial planning is a living, breathing, any document that we have, or any program that we have, is going to be living, breathing entity where we're making updates constantly. And, we can project out, hey, 5 years from now, or even 1 year from now, this is the order that you want to take these withdrawals from. And we work with you every step of the way to make sure that not only you're making the best use of your assets, but you're minimizing taxes, you're doing what's best for estate planning, and then we're also keeping in mind any other goals that you have.
Yeah, estate planning is part of that preservation. Insurance is part of preservation. I think, and income, retirement income, as you mentioned, is a big part of that preservation stage. So we've really covered grow, protect, and preserve. And I love talking about preservation. In fact, I think people need to work with Anselmo and Company and Brookside Tax to become part of the what I call the FPS, the Financial Preservation Society, right? Financial Preservation Society. That we can start our own group, and to become a member, you need to work with you and Chris, right?
That's right. Yeah. Our info is on the screen. And like Tony mentioned, we're going to look at your whole picture. We're not just looking for a transaction. I think that's a big misunderstanding here. We want to look at everything, because it all ties together. We have the ability. I've worked for companies in the past with different broker dealers, and they're fine companies. They're good companies, but I've never been anywhere where we can handle all this under one roof. It may not be the same person, but we can handle this all under one roof. So instead of me having to refer you to somebody across town, or even in another part of the state, I can walk 2 office doors down and ask Chris a question about, estate planning, and refer him to have to, put a plan together for you, and vice versa. So
and
we
you have
handle
tax
all that, and
professionals
taxes
there
too. Yeah, that's really what we're founded on. That's kind of our bread and butter is tax prep. So visit us online. Obviously, you can schedule an appointment there. You can call us. You can stop in. Since we've moved into our new office, I don't know if Chris has told you, we've received a fair amount of walk-ins, people that are curious about what we do. We're at an intersection where there's construction now, so that's tampering it a little bit. But ordinarily, a lot of through traffic getting to different parts of Greater Cleveland. So we've received some pretty good amount of walk-in traffic from people that are curious about what we do.
Yeah, that's awesome. You got a great location, location. I know Chris was excited when he found that building, and it's a bank. It used to be a bank, so there's a vault that
That's right.
is pretty cool to see. That's awesome. I love that. I love your digs there. It's perfect. And again, the location's handy for so many people. And if our listeners want to set up a consultation and come in, all they have to do is call 440-886 3550. And I want to give that number again for our listeners out there, our podcast listeners who aren't viewing, 440-886 3550. You can also go to youtube.com/@Brookside Financial. Or facebook.com/Brookside Financial. Check us out on Facebook, YouTube, or just brooksidetax.com. Tony, they can get a hold of you so many ways. They can see your lovely face. They can see your lovely tired face, see what it looks like to have a 2-month-old. No, you're looking pretty good for being up all night with your 2-month-old. Not 2 year, 2 month. Yeah.
Yeah. He'll be 3 months pretty soon. I gotta, my wife does a lot during the week when I'm working. I take a lot on the weekends, but it's been interesting. It's been an experience. I'm doing all right so far. With being alert, being awake, and things like that. It's so far so good. But a lot of that has to do with him and her as well. So
I'm sure your wife is. Yeah, she's carrying the heavy load, right?
Overnights, especially. Yeah. So like I said, during the work week, she handles a lot of that, so I can get up and go to work.
Right. Well, she's used to caring for someone. She's done it for you for a while now, so she's gotten her practice in. All right, I had to give you a hard time today, Tony. But listeners, thanks for tuning in. That does it for today's episode of Road to Retirement with our host today, Tony Marlette Jr.
All right, thanks, Tony. Thanks, everyone.